And welcome to another Leumi Financial Quarter. With us once again, Michael Zaremski, head of U.S. Private Banking, Bank Leumi USA, member of Investment Committee for Leumi Investment Services. Michael, good to speak with you again. How are you today?
Doing great, Sev. Good to speak with you as well.
Thank you. You know, we've been talking about it, but there seems to me a disconnect where we're seeing a surge. The media talks about daily, I guess you say almost every minute, about a surge in coronavirus cases throughout the United States, and yet we see the markets that are going up as well. So is there a disconnect between what we're seeing in the media and what's actually happening in the financial markets?
An excellent question, and it's a question that many of our clients are asking us. And a couple of different elements of that response. And, first off, these represent my views, not necessarily those views of the bank. But what I would like to say is I think that there are definitely a lot of cross currents of information, and because there's so much information out there, and because we live in such a politicized world, it's very tough to discern kind of fact from reality and what are the important facts. So I've been spending a lot of time trying to get deeper into the data on what's actually happening with COVID and trying to make the best assessment I can of it, because ultimately it's pretty tough to be arrogant enough to say that the markets are wrong. So if we do believe the markets are wrong, it's important to understand why we think they may be wrong or what the market may be missing. And generally speaking, the markets don't really miss a whole lot. So I think when we talk about the COVID cases, and we touched on this last time we spoke, but there's a little bit of a disconnect between the surge in new cases and what's actually happening with those new cases. And I think that there's many different cross currents that we're seeing, particularly as we kind of try to equate every situation that's happening around the country with the situation that we saw here in the Northeast back in April or so. And I think the first thing to really understand is the amount of testing happening in this country has skyrocketed. There's a really interesting website that I've been looking at, which is from Johns Hopkins University, and they have interesting data which talks about percentage of positive tests, daily total cases, and daily positive tests. And one of the first things that you do see is right now in our country, we're up to testing over 600,000 people a day for COVID-19 virus. Back at the end of April, it was about 250,000 a day, and in May it was 400,000 a day. So just by the sheer numbers of testing, the amount of people testing positive would certainly be expected to rise pretty significantly as the amount of testing has increased significantly. The other thing that we're tracking pretty closely, and again, the Johns Hopkins page has this, is tracking the percentage of positive tests. Generally speaking, the test numbers have been pretty low here in the Northeast. So again, the amount of positive test cases in New York is about 2%. In Texas, which we're hearing all the negativity about, and in California, but they're both somewhere around 10 to 12%. When you go to Florida and Arizona, the caseloads and the positive testing is far higher, somewhere around 25 to 30%. So again, disparities across different regions, disparities across different areas. But one of the other key elements that we focus on is the amount of deaths and the fatality rates. Last time we spoke, the 14-day moving average of fatalities in this country was somewhere in the magnitude of about 650 people a day from COVID. And right now, when we look at a moving day average of the last 14 days, which is basically since we spoke, that number is down to somewhere around 510 people per day. Again, a big number, but when you think about the fact that there's 7,500 people a day that die in the United States for various causes, COVID's representing a relatively small amount of the average daily deaths per day in the United States. So 500 out of 7,500. So again, I think that those are some of the key elements that we focus on, and I think that we're also in a period of time now where we're going to, again, I feel like I say this every time, but we're going to know shortly how real the spikes in Texas, Arizona, California, et cetera, are relative to the danger of the disease.
I think one other factor, because we're in a 24-hour-a-day news cycle, we've had SARS epidemics and other ones before where unfortunately many people lost their lives because of the news cycle. It gets so much more attention today, but the markets are reflecting the economy and what they believe where the economy is going to go, and therefore there is going to be a disconnect between the 24-hour sensational media, which is looking to push this idea because it means more viewers, and the markets are looking to see what the bottom dollar is.
You're exactly right on that point. And the news cycle is the daily snapshot, and the market is a forward-looking discounting mechanism on the future. And when we look at that, again, a couple of themes seem to be evident. The fixed income markets have been relatively range-bound. So again, there's not a whole lot of movement in where interest rates are meandering. And a lot of that is because there's been just an unprecedented amount of stimulus that's come in from the Fed. Again, the balance sheet has surged to over $7 trillion, whereas at the worst of the financial crisis in 2009, it was only at $4 trillion. So we've seen this huge insurgence of money into the market in terms of stimulus. And the question that I've been asking and what we're focused on is, where are we seeing opportunity? And when we look at the stock market, again, it's interesting that in general, stock market is far healthier than you would think it would be when you look at the snapshot. On a year-to-date basis, NASDAQ is up 15-16%. The S&P is down, kind of 0 to 3% depending upon the day, and the Dow Jones is down about 9% year-to-date. If you look at the pre-pandemic highs, NASDAQ is 6% over that. S&P is about 7% off its high, and Dow Jones somewhere around 12% off of its high. And what I think that's really reflecting also is a question of what we talked about prior, which is that we are in the digital age. We're in an information age economy, and a lot of the companies in NASDAQ are reflecting that. And the challenges that we're facing with the COVID virus are really forcing us to embrace technology and technological advancements in a way that we've never done so before, or I think in a lot of cases we've been hesitant to embrace, and now we're being forced to, so we're doing that. So more and more we're seeing a lot of these big tech companies, which in my mind are basically modern-day industrials. So if you think about the industrial companies of the 60s or the 70s, those were the leading-edge companies that were really driving the industrial age economy in the United States. Today those companies are Microsoft, Apple, Intel, and the like. Those are basically the modern-day industrial companies, even though they happen to be in the tech sector. The other thing that we've looked at quite a bit is gold. And gold is an interesting situation in that it's now approaching its all-time highs, which the last time we got up at these levels was kind of summer of 2012. In my mind right now, gold is telling you one of two things. There's either a lot of fear in the market in terms of crisis, so I want to retreat to safety of gold, or in its true fashion, gold is the ultimate inflation hedge, which is a fear of debasement of currency. So the thought process that we have right now, or that I have right now, is that we could be in a situation where if the market believes that the economic recovery is going to continue to accelerate, and again, we're seeing that in a lot of the jobs data, we're seeing that in terms of layoffs, discharge rates, the JOLTS report, which is job openings and labor turnover statistics. It does appear that the bottom of the market in terms of, the worst of it was March. We're seeing data continuing to get better. The last unemployment report had the overall unemployment rate for the nation at 11%, 11.1. Interestingly, in the field of information technology, the unemployment rate is about 4.3%. And again, I think that's reflecting old economy, new economy. So I think one of the issues that I'm looking at with gold as a factor is if people believe that the economic recovery is going to continue to move at speed above expectations, we could be in for a situation where the stimulus is in place a lot longer than necessary for economic recovery. Again, it's tough to square that with a lot of the daily headlines and a lot of the daily data that we're seeing with COVID. But again, as I went through some of the data in terms of the death rates, looking at the fatality rate in Texas, which is now down to 1.3. In Florida, the fatality rate is 1.8. In Arizona, it's 1.8. Again, as we're doing more and more testing, I think there's an element of saying that maybe we're getting to the point where we'll start to see the back end of that. But as usual, within a couple of weeks, we should get a better perspective on where COVID is going and therefore where economic recovery is taking us. And therefore, we'll kind of see how that continues to impact in the markets.
Michael Zaremski, head of U.S. Private Banking, Bank Leumi USA, member of Investment Committee for Leumi Investment Services. Thank you for being here with us.
Thank you very much, Zev. Look forward to catching up again soon.
And we're going to be right back. Don't go away. Stay tuned.